Hello everyone, in this video we're going to be going through the topic of impairment of property, plant, and equipment, impairment of PP&E. So what is an impairment? An impairment is when an asset has suffered a decline in value that requires a write-down of the asset. This is recorded as an impairment loss. So basically, an impairment is when we have an asset on the balance sheet, okay, and the value of it goes down, okay? And so what we have to do is we have to write down the asset, meaning we have to decrease the balance in the asset account. So if we thought the asset was initially worth $10,000, now it's only worth $8,000, well, we need to decrease the balance in the asset account by $2,000 in that case, right? Because otherwise, we'd have an asset sitting on the books at 10 when it's only worth 8, right? And so we have assets overstated, okay? So basically, that's what an impairment is. It's an impairment loss. An asset may become impaired for many reasons, such as cash flows generated by the asset are lower than expected, the economy enters a recession or a depression, and then the fair value of the asset declines significantly. So there's just some of these reasons that an asset become impaired, just so you guys are aware. Not that you necessarily would need to memorize that, but just so you're aware. If a company believes an asset may be impaired, it must perform a two-step impairment test. Okay, so we're talking about the impairment test for property, plant, and equipment specifically. There are other impairment tests for intangibles and goodwill and things of that nature. Those are covered in different videos, and those tests are potentially a little bit different. We're talking about specifically PP&E. When I say an asset, I mean PP&E. Okay, we're performing a two-step impairment test. Step one: determine if an impairment had occurred. Okay, so has an impairment occurred? Yes or no? Okay. So what we do to determine that is the recoverability test. It's a measurement of whether the undiscounted cash flows, all future cash flows the asset will generate, are greater than or less than the asset's carrying value. Okay, so what we do is that we just determine all the cash flows of the future. Okay, maybe all the cash flows are $50. Okay, and then the asset's carrying value is $40. Okay, in that case, what we're going to do is that we're going to see we have two rules here. Okay. So if the undiscounted future cash flows are greater than or equal to the asset's carrying value, no impairment has occurred. If the undiscounted cash flows are less than the asset's carrying value, the asset is impaired. Okay, so in this case, if our future cash flows are $50 and then the carrying value is only $40, that would be a situation where we do not have an impairment, right? Because the undiscounted future cash flows are greater than the asset's carrying value. And so if it was a situation where these were flipped, okay, now the cash flows are actually only 40 and the impairment value is 50, and carrying value is 50, then we have an impairment, right? Because now the undiscounted cash flows are less than the asset's carrying value. When we're talking about the recoverability test, basically what we're saying is, are we going to recover the asset's value with the future cash flows that we're going to get? That's why it's called the recoverability test. And again, when we're saying undiscounted future cash flows, we just mean all cash flows in the future, just the actual cash flow itself. We're not doing any discounting for time value of money, okay? That's what I mean by undiscounted future cash flows, okay? So then, let's say that we have an impairment. Then we go to step two, okay? Step two says determine the amount of the impairment. Here, the company discounts the cash flows from step one to determine the asset's fair value. The fair value is compared to the asset's book value, with the difference being the impairment loss. Okay, so then we discount these future cash flows, we determine the fair value, and then we compare the fair value to the book value, and however much the fair value is lower than the book value by, that will be the loss. Okay, and again, to reiterate, step two only occurs if the asset is deemed impaired by step one. If step one says there's no impairment loss, we do not do step two. Okay, just to repeat, if step one is saying no impairment has occurred, if the cash flows, the undiscounted cash flows are greater than or equal to the carrying value of the asset, we do not perform step two, okay? So we'll see an example like that just to remind ourselves, but just so that way we note that right now, okay? Then we have two types of impairments. There's impairments for assets held for future use, and then there's impairments for assets held for sale. Assets held for future use. An impairment of an asset held for future use cannot be restored. So if we impair an asset that we're going to hold for future use, meaning that we're going to continue to use it in our operations, then that means that we cannot restore that asset. We cannot restore that asset to its initial value from the impairment loss. We cannot restore the impairment loss. Also, these assets are continued to be depreciated. Okay, so when you have assets held for future use, we depreciate them and we cannot restore the impairment loss. Then we have assets held for sale. An impairment of an asset held for sale can be restored. Write-ups of the asset can never exceed write-downs. And then these assets are treated like inventory and carried at lower of cost or net realizable value. Again, net realizable value is selling price minus cost to sell. If we remember LCNRV, that was from one of the previous chapters when we talked about inventory, one of the previous topics, okay? These assets are not depreciated anymore, okay? So basically, we have two different types, right? So if it's held for future use, we don't restore the impairment loss and we depreciate the asset. If it's held for sale, we can restore the impairment loss, and also the assets are not depreciated, okay? So now, let's go through quite a few different examples. So first, we're going to do some impairment testing examples. On January 1 of 2014, XYZ purchased equipment for $50,000. At that time, the company estimated that the equipment's useful life will be 10 years and have no residual value. The company elected to use straight-line depreciation for the equipment. On December 31 of 2017, XYZ was concerned that the equipment it purchased may be impaired and performed an impairment test. The following information is available concerning the asset as of December 31 of 2017. Then we're given these three next years, 2018, 2019, and 2020, and then the expected future cash flows. These would be our undiscounted cash flows, right? These are just straight up the cash flows in the future that will occur in the future that we're not going to do anything to them. We're just going to determine what they are. Additionally, the appropriate interest rate to discount these cash flows is 10%. Required, prepare the entry to record the impairment of XYZ company's equipment. If no entry is required, write no entry. Step 1, right? We perform the recoverability test. The undiscounted future cash flows are $33,000. We just add these up, right? We get $33,000. This is greater than the asset's carrying value as of December 31 of $30,000. How do we know what the carrying value is? Well, it's cost minus accumulated depreciation. The cost was $50,000 initially, okay? Then we would have done $5,000 of depreciation per year. How do we get that? Well, we're doing it straight line with zero residual value for 10 years. That's $5,000 per year of depreciation. Okay, we would have taken 4 years of depreciation as of December 31, 2017, so that'd be $20,000 of depreciation, right? So we have $20,000 of accumulated depreciation. It cost us $50,000. We've taken $20,000 of accumulated depreciation. That means our carrying value is $30,000, okay? Now, we go to our rule. Our undiscounted cash flows are 33. Our carrying value is 30. We're right here. The undiscounted future cash flows are greater than the asset's carrying value, so no impairment has occurred. So we stop at step 1. We do not do step 2. So it says no impairment has occurred. Do not go to step 2, which means that as of December 31, 2017, we have no entry. There is no impairment occurring. However, this is like a trick question, right? Some people might call this a trick question. I wouldn't call it a trick question, but a lot of people might use that terminology. I would just say this is making sure you're awake and paying attention, okay? People say it's a trick question because the discounted amount is $27,355, which is actually less than the carrying value, right? And so if we were to say, oh, let's do step 2, well, okay, well, let's do step 2. We discount the cash flows. Again, this is just the $33,000 discount at 10%. That would be $27,355. Okay, once we actually get below, if the fair value is below the asset's book value, that would be, the difference would be an impairment loss. However, we don't even go to step 2. We do not perform step 2. Okay, so if we actually perform step 2, we would end up with an impairment loss of $30,000 minus $27,355, which would actually give us an impairment loss of $2,645, which is not correct because an impairment loss hasn't even occurred because we actually met the recoverability test. We actually passed the test, right? If we pass the test, that means that the future cash flows are at least equal to the carrying value of the asset, which they are. They're actually greater than. Okay, so there's no impairment. So don't make the mistake of going to step 2, because if you do, you will end up getting it wrong. Okay, now we're going to use the same information above. The only difference is now the expected future cash flows are going to change. Okay, again, the interest rate is still 10%. So now it says prepare the entry. If no entry is required, write no entry. So it's literally the same facts. We're still at December 31, 2017. Everything's the same. Okay, step 1, perform the recoverability test. Undiscounted future cash flows are $27,000. We know that the book value is $30,000. We did that, right? We said $50,000 of cost minus accumulated depreciation of $20,000 because we did $5,000 of depreciation per year, right? Times 4 years gave us $20,000 of depreciation, accumulated depreciation. Again, $50,000 minus zero residual value divided by 10 years for straight line, right? That's how we got $5,000. Okay, now we have an impairment loss, right? Because the undiscounted future cash flows are less than the asset's carrying value. So an impairment loss has occurred. We must perform step 2. Now we go to step 2. because we fail the recoverability test. We fail the recoverability test because, again, the undiscounted future cash flows are less than the asset's carrying value as of December 31, 2017. Okay, so now we're on step 2. So now we have to discount the future cash flows and compare to the asset's carrying value to record the impairment loss. Okay, if we discount $9,000 for 2018, 2019, and 2020 to the current year, okay, assuming that these cash flows occur at the end of the year, at 10%, we get $22,382. Okay, I just skipped that time value money calculation, but if you need to go through it, that's the way that you would actually go through the problem. Okay, so the discounted future cash flows are $22,382. That's our measure of fair value. As we said on the first page, the asset's fair value is the discounted future cash flows. Then we compare the fair value to the asset's book value, and the difference is the impairment loss. So we have the asset's book value or carrying value is $30,000. We subtract away $22,382. That's the fair value, which means the impairment loss is $7,618. Okay, so our impairment loss is impairment loss $7,618. Accumulated depreciation $7,618. Okay, why are we writing it down by this much? Well, we have the asset currently on the books at $30,000. We want the asset on the books at $22,382. Well, we have to do the difference. We have to write it down by $7,618. So that way our asset is stated on the books at the fair value now. So that way it's not overstated, right? We kind of talked about at the beginning a little bit. We don't want the assets to be overstated. And this is how we're making sure they're not overstated, by putting it on the books at its new cost basis, which is $22,382. We're writing it down to that basis. We're decreasing the value in the asset account. Okay. Now, so that's the end of the first example. Now we're going to go through a couple things. Excuse this at the bottom. I'm not sure why, but I could not figure out how to get this to go in. My printer just kept printing it in that way. So apologize for that. I kind of wrote what was written there, so it should be okay, but it doesn't look like that in the Word document, but for some reason, every time I try to print it, it keeps doing that. Not sure what the issue is. But anyways, now we're going to go through a couple other situations. So basically, this is going to highlight, if we go back to the first page, it's going to highlight, the first page is highlighting the two different types of impairments. The ones where we hold it for future use versus held for sale. Again, if we hold it for future use, we depreciate the asset and we do not restore the impairment loss. But if we held it for sale, then we can restore the impairment loss and we do not depreciate the asset. Okay, just keep that in mind as we're doing these problems. So now we're going to be at the end of the next year, which is December 31 of 2018. And we'll say we use the facts from scenario 2, so that's this scenario, okay, of the problem directly above. So this is like scenario 2 of the problem above, because if we remember, we had this first page, and so this is basically like scenario 2, okay? Additionally, assume that on December 31 of 2018, XYZ determines that the discounted cash flows fair value of the asset is now $29,000. So we're actually just given the discounted cash flows or the fair value of the asset, okay, as of December 31 of 2018. Okay, so it says, prepare all the necessary journal entries dated December 31 of 2018, assuming that XYZ intends to use the asset in its operations. Okay, so now they're going to use its operations, which means it's held for future use. Okay, so in that case, if we remember, we have to record depreciation expense. So what we do is that we take the new cost basis, which is $22,382. We solved for that in the previous scenario, right? Because we wrote the asset down. We wrote the asset down to its new cost basis of $22,382. Okay, so that's what we're going to be depreciating going forward. We're going to use that, and we're going to depreciate it over the remaining amount of time. Where does 6 years come from? Well, we started off with 10 years when we first bought the asset. Okay, we first bought this asset January 1 of 2014. It said it had 10 years left. Then 4 years later, okay, we've taken 4 years of depreciation as of January 1st of 2018 or December 31st of 2017, however you want to look at it. So that would give us 6 years left of depreciation, because we start off with 10, we've taken 4 years depreciation on this asset, we have 6 years left. Okay, now we're going to record $3,730 of depreciation expense. Okay, so depreciation expense, $3,730, accumulated depreciation, $3,730. Okay, again, we're using this asset in our future operations. It's held for future use. We're going to depreciate the asset, and we're not going to restore the impairment loss. So then the second journal entry is no entry for impairment restoration because the asset is held for future use, so we cannot restore that. Okay, again, to just go over this again, this $22,000 comes from here. Okay, once we write down the asset on December 31st of 2017, the prior year, that is our new cost basis, which means that's the amount that we're going to depreciate going forward. Okay, the 6 years again is from 10 years total for the asset minus the 4 that we've used up from 2014 through the end of 2017 gives us 6 more years going forward, starting on January 1st of 2018. Okay. Then we have the same facts as above, except now the cost to sell the asset are $500 and the company intends to sell the asset in the future. So now we're holding the asset for sale. We're not using it for future use. So now an impairment of an asset can be restored and the assets are not depreciated. So first, there's no entry for depreciation because we don't depreciate assets held for sale. Then we need to determine, can we restore part of the impairment loss? Okay? So we are told that the current fair value is $29,000. Okay. Now, when we are doing assets held for sale, we're going to treat these assets like inventory. We're going to value them at the lower of the cost or the net realizable value. Now, the net realizable value is going to be the selling price minus the cost to sell. Okay. So the net realizable value. So in this case, the selling price would be 29. So the fair value, it's basically interchangeable. Okay. So we have 29,000. For NRV, we're solving for NRV. It'd be $29,000 minus $500, okay? Because it tells us that right up here that the cost to sell the assets are $500. So we do 29,000 minus 500. That gives us 28,500 as our new NRV, okay? Then the actual cost of the asset initially, okay, would have been higher than this amount, right? It would have actually been basically, it would have been, let's see. The current carrying value of the asset is $22,382. So we're permitted to write the asset up. Basically, the difference between the two, we're allowed to write the asset up by that much. Okay, so the recovery of the loss is going to be $28,500, which is the current NRV, minus the $22,382. Okay, that gives us a recovery of a loss of $611. $6,118. So the way that we do that is that we debit accumulated depreciation for $6,118, and we credit recovery from recovery of loss from impairment for $6,118. Okay, so as opposed to impairment loss, we have a recovery of a loss here. Okay, so basically what happens here is that if we look back to our facts here, okay, our write-ups of the asset can never exceed the write-downs. Okay. So let's go and see what we did before. We wrote down the asset by $7,618, right? So what that means is that we can never write the asset up by more than $7,618. Excuse me, I'm having a tough time talking right now. We can never write up the asset by more than the amount that we've written it down. So in this case, we wrote up the asset by $6,118. That's perfectly fine. Okay, we can restore the recovery. We can restore the asset up to the amount that we wrote down before. Okay, so that's perfectly fine. Basically, what it was that when we're doing LCNRV here, right, our cost was $30,000 before we wrote this down, right? But the net realizable value now is $28,500. Okay, so we want it to be stated at $28,500. Okay, because we're carrying this asset, we're not depreciating it anymore. So again, when we're doing this LCNRV, we have to be a little careful of what we're saying is cost. Cost is basically going to be the carrying value of the asset, the carrying value of the asset before you wrote it down in the previous year for when we're doing the specific scenario of the asset is going to be sold in the future. Okay, so we'll do the cost from before we actually wrote down the asset versus the NRV now, which is $28,500. So we're allowed to restore the recovery of the loss up to $7,618. We only restore $6,118 here, so we're fine. Okay, we're okay. So this is a debit to accumulated depreciation. This is a credit to recovery of loss from impairment. Excuse me, I got a little bit confused there for just a second, but that's how you do it. But yeah, so essentially, just to review on this one, we don't depreciate it, right? And then we can restore the loss. We can restore up to $7,618 of loss. We can't write it up above there because then we would write it up above $30,000, which is what the carrying value was before, right? Which would not make any sense. We're going to write it up above $30,000. That's almost like overstating our assets, right? And so we can restore up to $7,618 of loss. Here we're only restoring $6,118, so we're good. Okay. The only thing is, right, if NRV here was like 30,500, right, we couldn't actually restore it to NRV. We can only restore it back up to 30,000. So we could restore $7,618. So, excuse me if that got a little confusing at the end with these lines and stuff. I was getting a little bit thrown off. But basically, yeah. So basically, that's how you do that when you have it held for sale versus when you have it held for future operations for future use. So that is the end of this video, and I hope that was helpful.